Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter. I'm going to give you my financial opinions. It'll probably be related to either financial financial related topics, commodity related, or wealth related topics. Again, if you want to follow me on Twitter, you can follow me at finding_finance, or you can follow me at the website finding-value.com. That is where I share my portfolio. I share the companies that I'm playing it with, or the physical metals that I am buying and when I'm buying it. Obviously, I've got a great affinity towards the physical metals, as that's probably one of my favorite sectors. So coming in down here, we've got Capex is coming back. The commodities bull market is based on three pillars: geopolitical conflict, a Capex-led cycle, and widespread risks to supply. Marco Pepic. We feature a chapter about the commodity Capex cycle. Oil and copper in particular experienced significant periods of underinvestment in recent years. How will this play out? Read all about it starting on page 349. So here is the top 40 mining companies' Capex expenditure in United States dollars, billions. And we are coming up from the bottom of 2016. We probably have a much larger cycle this cycle, as we need to invest more to get less, as weird as that seems. Invest more money to get less ore grade and less pounds in the ground of whatever it is. Coming on down, we've got 5. Money supply growth in the United States, calculated on a monthly basis, is negative for the first time since the 1950s, and on an annual basis for the first time since the Great Depression. And I know some people have been talking about the M2 money supply, how we could see a problem with this decline going underneath the zero mark, much like the 1920s and even the 1930s. We'll see how this plays out. Could we get a slowdown in the markets? We definitely could. I'm not denying that. And the M2 money supply in the short term is looking kind of nasty. Generally speaking, when we see the M2 money supply do this, it generally shows up in the market a little bit later, maybe a year out. So we've got about a year maybe before this M2 money supply really starts hitting a lot of the data. So get ready. We could see a pullback here. Here's Grady. He's got oil chart up here. It says, nowadays, macro has too many parameters for anyone to get it consistently right. Based on that alone, we've nailed most major lows and highs on the surface for the oil sector since March 2020. And I really like this oil chart. It's a longer-term oil chart with a shoulder, head, shoulder, coming up with the neckline here. And we just basically blew out to the downside in 2020. We've come back up, and we're coming back and doing a retest of this breakout trend line. It's a 50% retracement level. Is there a possibility that we hit a 61.8 at $54 a barrel? That is a possibility. I'm definitely not ruling that out. It is possible, but we are at support, and we'll see if that support holds. That is what I'll say about oil. Oil is also at a very cheap level in relationship to gold. Coming on down, Warren Pies. He says, reminder, you can tweak excess savings analysis a number of ways to create whatever narrative you prefer. More useful to study aggregate checkable deposit data. After increasing by $4 trillion during the pandemic, total checkable deposits just began rolling over in Q4. We saw a massive rollover in checkable deposits from 1994 all the way to the bottom of 2008. Is this going to be a similar setup where checkable deposits get spent into the system and it rolls over for a very long period of time? That could be the case. I don't know. But we're at a very high level right now, and it's just starting to roll over. Looking at the game of trades, bonds are setting the stage for significant upside. Monthly momentum is on the verge of flipping bullish. This is what he's using for this. This is generally an indication that doesn't work very well for me in the past, the MACD. I generally don't even look at that. When looking at the chart actually looks pretty crappy for a move to go higher because you've got this large selling pressure day or week. This is not a selling pressure month this past month, but that could be contributed to the debt ceiling problem stuff. So could this come all the way back up to a trend line that goes up here to do a return move and then a flush out afterwards? That is my best guess. I think we'll go higher in the short term to an extent. We're going to turn at the trend line. There's no trend line in here, but there's a trend line that goes through here. We'll turn at the trend line, then we'll crash back further to the downside eventually. This is the average 401k balance by age per Vanguard. So coming on down to the next one, if you were given $1 million today, what would you be doing with it? Well, I know what I would be doing with it. I would probably be buying some dividend stocks in some commodity areas. And then I would also put some away for a rainy day in some physical precious metals. That's what I would be doing. And you know, my boy Platty, he's hungry over there. He needs to be fed. So we'll feed him some cash. He'll spit me out some physical metals, and we'll all be good. And then the dividends, I could use that to kick out some more cash flow to acquire more metals and to acquire more things. And if my cost of living goes up, hopefully that will offset it as well. I did have a talk with UseLink. We went over a bunch of different sectors here, and we talked about oil, uranium, silver, platinum, and a bunch of different kind of sectors around those sectors. You can look at that. We talked about some ratios as well. I also just posted evidence for commodity supercycle that's still coming. Again, I don't know the timing necessarily of it. We could get a slowdown in the markets here in the short term, but everything is still intact from a long-term perspective. Here's a guy, he says, if you live in a high-growth, high-tax state like Texas, and you have the option to prepay your taxes at today's rates to lock in for 5 to 10 years, would you do it? Share your rationale below. I would do it. I think that we're still in a real estate bull market or bull cycle. In the short term, yes, we could see some weakness, which we're seeing. But over a 10-year period, I think we're going to go higher than where we are today. So I think that the real estate market, when it moves during this portion of an expansion phase of real estate, we could see a good move to the upside still. I know that sounds weird, but that's my opinion on it. And interest rates, I think, will go back down at some point, causing that move to go up, based off the underbuilt situation. This is just one way to lock in your costs and know what they are, and to cover them. I know my taxes have gone up dramatically this past year. It would have been good to lock it in like 2 or 3 years ago and just pay forward 10 years. I would have easily done that. I would have done that in 2018 when I knew that I was originally buying. My property taxes were like $1,800 or something back then. If I could pay that amount all the way forward, I would be sitting very pretty. I would have done 10 years, definitely. If it was from where I paid those property taxes, I think in 2018, I think is what it was. It was at that price. So the U.S. has added $8 trillion in federal debt since 2020, now at a total of $31.5 trillion. To put this into perspective, it took the U.S. 227 years to add the first $8 trillion in debt. With the new debt ceiling bill, the debt limit will be uncapped until 2025 at this rate. If a recession hits or a stimulus event takes place, we could easily be near $40 trillion in federal debt. 25% of all government revenue would go toward interest expense. We need a long-term solution. You know what's even crazier, guys? If they don't print a bunch of money, if we don't get inflation, I don't know how they're going to keep tax revenues up. If we get an asset price decline, whether that be real estate prices or the stock market or both at the same time, their tax revenues go down, the state and the federal government. They need inflation. They want inflation. Inflation is going to increase tax revenues. And if they don't get that and they have these interest payments that still stick around, you're going to see even larger deficits than what most people can think imaginable, because you're going to have tax revenue decline at the same time that your interest payments go up. That will be interesting. This is from Mining Charts. It says uranium miners against the price of uranium. The mining stocks are back to the 2020 breakout level, getting back to bargain levels. And that is what we were talking about, we being Casper and myself. We're at very low levels here. I'm not saying that this can't go lower, but we're back to 2020, and we very well could find support here. It's possible. Or maybe we have a flush out down move to the downside before that happens. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you like. Definitely check out finding-value.com. If you want to become a member, use the word discount in the coupon code. Get yourself a discount at least. We do have a Sunday Platinum question and answer session at 5 p.m. Mountain Standard Time if you're interested. And you can ask whatever questions you want over Zoom with me. So that's what I've got for today. Hopefully you guys are doing all right, and we'll catch you later. This is Finding Value.